What exactly does interest accruing daily versus interest accruing continuously actually mean? Vincent Chan here from The Simple Dollar, and in this video we're tackling just that and truly understanding what exactly does interest accrual given a specific timeline actually mean. And if that sounds good, make sure you smash that subscribe button, because here at The Simple Dollar we produce the latest and greatest on money and personal finance. Firstly, let's understand what interest accruing annually actually means, given that most of the situation, this is what people mean when they talk about interest accruing. It's a simple and easy application for us to understand. And before we actually dive into it, let's define what the word accrue means. If we're talking about it in the sense of interest, what accrue means is a bank essentially calculates how much interest it owes you or how much interest you owe it as it applies it to your balance. For example, let's say you're $100,000 in debt with a 12% interest rate. Simply what that means is if the accrual happens at the end of the year, in order to determine what your new interest is going to be, you multiply $100,000 times 12%, which gives us $12,000. So at the end of the year, after the interest accrued, the new debt that you owe the bank is going to be $112,000 because of the $100,000 plus $12,000 interest accrual. Oftentimes on your bills and advertisements from companies, you'll see two different phrases being used: APY and APR. APY stands for annual percentage yield and APR stands for annual percentage rate. With interest that is accrued annually, there's literally no difference between these two definitions. However, the differences come into play when accrual happens more frequently. Now let's actually talk about interest being accrued monthly. And this is where things get a little bit complicated and differentiates between interest rates accruing annually. The first number to take into account is called APR, or annual percentage rate. And this becomes extremely important when it comes to debt and savings account, because this essentially determines how much the savings account will pay you in a given year. If you're accruing monthly, you have to take the APR and divide it by 12 equal parts to account for the 12 months in a year. So let's look into the example that we mentioned earlier with the $100,000 in debt with a 12% APR. What you want to do now is divide that 12% APR by 12 months. And essentially what that gives you is a 1% APR per month. So in January, what you want to do is you take your $100,000 in debt and you multiply that by 1%, giving you a return of $1,000. So your new balance is going to be $101,000. And in February, you pretty much do the same and you take the new balance of $101,000 and you multiply that by 1%, giving you $1,010. And what you want to do with this new amount is you add it back to your balance, yielding you $102,010. And you pretty much do this every single month until you hit December. So let's actually fast forward to determine what is the final amount at December. So starting in December, your new balance is going to be $111,566.83. If you multiply this new balance by 1%, you get a $1,115.67. And what you want to do is add it back to your final balance, which gives you $112,682.50. On the flip side, and you should definitely take this into account, is if we accrued this annually instead of accruing it monthly, our new balance starting off with the $100,000 in debt would actually be $112,000 at the end of December. And the dollar difference in this case when the debt is accrued monthly versus annually is $682.50. And here's where APY gets really important. In this case, the APY is 12.6825%. If you take the original debt amount of $100,000 and you multiply it by this percent APY, what you're gonna get in return is $12,682.50. If you add that amount back into the original debt of $100,000, then you get the same amount if you actually accrued monthly. In other words, APY is a terminology that banks mostly use when there are more frequent accruals happening. When banks want to make the interest rate look bigger, they'll quote using the APY, for example, if they're using a high yield savings account. However, on the flip side, if they want the interest rate to appear lower, they'll quote the APR, similar to how it's done when you apply for a loan. Next is when interest rates are accrued daily or continuously. And I want you to keep it in mind is that when interest accrues more frequently, it will be better for you if we're talking about a savings account. However, if it's more frequently and we're talking about a loan or you're in debt, then it would actually be worse for you. So let's look again at our example earlier with the $100,000 in debt with a 12% APR. If your interest is being calculated daily, then what you want to do is divide that 12% by 365. given the 365 days in a year. This would actually give you a 0.032876712% calculated each day. Then what you want to do is take that percent and do the same calculation like we did before, but instead you do this 365 times. And I'll save you the trouble of actually doing it. If interest was accrued daily, you'll end up with a balance of $112,747.46. In other words, this debt would have an APY of 12.74746%. And the main difference here is that it uses a mathematical formula to continuously slice the amount of time until the time slices reach 0. If you actually want a more detailed description of how this happens, check out the video description down below and check it out on thesimpledollar.com. If we apply the same example with this continual accrual method, the balance is going to be $112,749.69, or a 12.74969% APY. The reason this is important is because it's all about the money, and depending on how much money you start off with, the actual accrual interest frequency will have a large impact. And this could mean the difference between hundreds of dollars versus hundreds of thousands of dollars. If there's a single message for you to take away from this video, is essentially if you are borrowing money, you should focus on the percent APY, because this is the actual interest rate that you'll be paying when you take into account all the different accrual timeframes. In a situation where the APR is pretty similar across the banks, the accrual rate is going to make the difference between hundreds of dollars or thousands of dollars. And the reverse is true when it comes to actual savings account, and the APY will determine how much money you'll actually make if you store that money within the savings account. As always, if you have any questions on this topic, please leave a comment down below and we'll get back to you with answers as quickly as possible. And remember, if you want the latest and greatest on money and personal finance from The Simple Dollar, remember to hit that subscribe button. And as always, Vincent Chan signing off.